Okay, good afternoon, everyone, and warm welcome to our distinguished guest speaker today, my friend and colleague, Ms. Nancy Jacklin, and who will deliver a formal presentation, which, as you know, we have titled The IMF and its Ongoing Policy Relevance in a Changing Geopolitical Landscape. So the session today is both part of the London Financial Regulation Seminar, which, as you know, is an intercollegiate and interdisciplinary group of experts, which is led by the Center for Commercial Law Studies and our Institute of Banking and Finance, under the leadership of myself, Professor Rosa Lastra, and Dr. Daniele D'Alvia as my Deputy Director. And the session today is also part of the course that the students that are registered for the law of international financial institutions have started learning starting last week as part of this term too. And I have been working and having Nancy as a friend and colleague for decades. I had the great privilege of working with her late husband, Sam Cross, in Columbia University, and Sam Cross himself had a lot of experience working in international organizations such as the IMF, as well as working in distinguished institutions, including the Federal Reserve Bank of New York, where he was the second in command to the legendary Paul Volcker, among many other career heights. And Nancy herself has a most distinguished career in the legal field, but the legal policy field. She was, which is relevant for the session of today, the seminar of today, a former US Executive Director of the IMF, and she was also experiencing in both private practice. She was a partner at Clifford Chance, as well as in the private sector with Citibank. She also served as Assistant General Counsel for the Federal Reserve Board of Governors in Washington, and she is a graduate of Georgetown University School of Foreign Service and Georgetown University Law Center. And as many of you know, we also work at Queen Mary very closely with Georgetown, among other things, Anna Gelpen of Georgetown and myself, or the co-directors of the Sovereign Debt Forum, being sovereign debt another of the fields in which Ms. Nancy Jacklin has a great deal of experience and expertise. Those of you that take with me the law of international financial institutions know that Brettonomics, which is a series of educational podcasts which she has developed and in which she sits with experts for the benefit of non-experts which are interested in the Bretton Woods Institutions and other international financial institutions, as well as other international matters. And this series, which she has developed and created, helps really with the understanding of international monetary and economic affairs, why they are needed, how they have evolved, and how they get things done. And so, Nancy, thank you very much for having developed what is an extremely valuable material for students that want to specialize in this field, and sharing your enormous experience, expertise, as well as insights in interviewing the who is who in the field, as the students that are already listening to the podcast know. But today we're going to focus on an area, on an institution, which I know is dear to your heart for many reasons. I just explained why, besides your own personal history, the importance that the IMF has as the center of the international monetary and financial system. So without further ado, because I could talk about you and about what you're going to talk for the rest of the session, and we just have 1 hour, in my privilege as chair, I just want to extend this very warm welcome to you, thank the students that and the experts that have registered for today's session. And the format is, as you know, that you will talk first. Given that this is online, we find it is easier rather than having interruptions, that you talk first, and then we have a Q&A at the end of your presentation. And I will also manage the Q&A and ensure that everyone has a fair chance of asking any question that they may have. But the session will be recorded, and so for the purposes of the good recorder, I will now silence myself, put myself on mute, and give the floor to you. Thank you very much for making the time to for being with us today, but also for having developed this wonderful series of Brettonomics. So thank you, Nancy, and the floor is yours.
Okay. Well, Rosa, thank you for that lovely introduction. And as you say, we go back many years together, so it's always a pleasure to do things as a team. So I'm happy to be here today. So today's talk is, as Rosa said, is going to be about the International Monetary Fund and its ongoing relevance in some pretty turbulent times in international economic relations. In order to think about the future, though, I think it's important to be grounded a bit in the past. And so bear with me, as what I plan to do in the next hour, and as simply as I can, is explain why the IMF exists, how it's evolved, how it works as a practical matter, and then talk about why it's still needed today, and perhaps more than ever. So let's go back to the beginning briefly on why the IMF was born at the Bretton Woods Conference in 1944. The simple answer is that the international monetary and trade policies of governments in the 1930s had made the global economic recession far deeper and far worse than it might have been. It became, as we know, the Great Depression. The recession began at a time when countries active in the global economy had their currencies linked to gold. That is, the gold standard was in force. Now, under that standard, a country's external balance of payments had a direct effect on the money supply within the country. And so what it did was limit the economic tools available to a government to pursue domestic economic objectives. But nations believed at that time in the benefits of global trade, and they thought the gold standard was a good way for the relative values of currencies to be adjusted. Once the Great Depression made that system unbearably constraining because countries could not adopt the expansionary domestic economic policies they needed to address the horrible economic downturn, it really started to fall apart. And not only did the major economic players start to remove or limit their gold standard constraints, but the 1930s were an era when countries acted as if international economics was a zero-sum game. In other words, I could win only if you lose. So countries started using trade barriers and exchange rate depreciations to gain competitive advantage internationally. These policies are often referred to as beggar thy neighbor policies. And the losers, such as Germany in this competition, suffered dire economic and financial consequences that, as we all know, had some terrible political repercussions too. So the 730 delegates from 44 countries who convened in 1944 at Bretton Woods believed that had a more cooperative framework been in place, the result would have been a larger economic pie globally, from which each country could benefit, and thus a milder economic downturn for the world economy. This extraordinary conference determined to create an international cooperative institution that might prevent beggar thy neighbor policies in the future. And I don't need to tell you that there are a lot of lessons to be learned from this history. So let's talk about the IMF and how it does provide that cooperative framework. It has a couple of functions. First of all, it sets the rules of the road for members' exchange rate policies and for their broader macroeconomic policies. These policies are expected not only to foster that country's economic stability and growth, but in doing so should not be designed to, nor should they likely cause, adverse effects on others or on the stability and sound functioning of the system as a whole. Oversight of these rules of the road is conducted under Article 4 of the IMF Articles of Agreement, which is the IMF's policy surveillance function. Now, at the beginning and for several decades thereafter, the principal surveillance function of the IMF was over members' exchange rate policies and practices under what was then the par value or fixed exchange rate regime of the IMF. This was a system under which members were obligated to take actions to maintain the declared exchange values of their currencies and to do so fairly. It was also a period when extensive capital controls existed, particularly in post-war Europe, and they were gradually being lifted, so there was a fair amount of surveillance around that transition. After the major reform of the IMF in the 1970s, which I'll talk about a little bit more later, when the world moved to more flexible, if not freely floating exchange rates, more emphasis was placed on the broader macroeconomic surveillance. Over time, the world economy was more integrated, and some of the IMF's most important work became its multilateral surveillance, which looked at the interplay and the spillover of one country's economic policies to the broader system. And then as global financial markets became larger and more integrated, particularly in the 1980s and 90s, with potential serious global financial stability and economic impacts that we all have seen, the IMF assumed greater responsibility for surveillance of financial risk and financial systems. Well, in addition to the Article 4 country reviews, therefore, there are now both regional surveillance reviews and also some global flagship publications of multilateral surveillance, namely the World Economic Outlook, the Global Financial Stability Report, and the Global Fiscal Monitor, which looks at spending and tax policies internationally. Now, what I encourage you to do to make the surveillance kind of meaningful and tangible for you is to take a look at the IMF's website and look up your own home country's latest Article 4 review, so you can kind of see what that's all about. And then look at some of these multilateral surveillance papers to see how your country's activities fit into that broader picture. So that's surveillance. Now, another very important function of the IMF is its financing. And it aims at promoting responsible economic policies of members and avoiding competitively destructive policies. And it does so by providing financing when a member faces an external trade imbalance or inability to finance its international accounts. That is, it helps members address a so-called balance of payments problem. This short-term financing is accompanied by conditions, namely that the member adopt policies designed to correct the imbalances. And these often involve the tightening of budgetary and/or monetary policies. They can have some structural economic reform requirements and possibly changes in exchange rate policies. With the IMF financing, a member obtains time to make these domestic economic adjustments in an orderly way. It avoids the member having to take more extreme domestic actions that can cause deeper economic hardships and potential political instability, and other adverse effects such as mass emigration flows, and also reduces the risk of the country adopting beggar thy neighbor policies to try to deal with their lack of competitiveness at a faster pace. So the role of the IMF in this is very important and increased and changed a bit in the 1980s when capital markets flows to emerging countries grew exponentially. And the size of payments imbalances which occurred required not only official creditor support, but also support from the private sector creditors of the debtor countries. The IMF's key role in these balance of payments packages, which often involve not just new financing, but restructuring of existing debts, was to provide an important view of an impartial view, of the policy measures needed by the country to get itself back on track, and to also determine the time frame during which those policies could be adopted and then become effective. So once you have that picture, the IMF could provide a judgment on the determination of the so-called financing gap. In other words, what kind of monetary flows were needed during that adjustment period in the form of either new money or debt restructuring by the public and private sector creditors of the country dealing with the IMF program. Now, these decisions require judgment, and there is no one clear right or wrong answer. But the IMF has the expertise, the experience, and as close to an objective position as can be found to play this determinative role. Now, as many of you know, the IMF's financing role is not just limited to emerging markets and lower income countries. I personally worked in 1976 on the IMF's program for the United Kingdom, which was facing enormous selling pressure in the currency market and driving down the value of the pound sterling. And this was due to the UK's balance of payments deficit and its domestic economic policies. At the time, I was a young attorney working on an emergency rescue by the US Treasury and the Federal Reserve, which entered into a short-term currency swap arrangement with the UK Treasury to help support the pound, while the UK finished negotiating its program with the IMF. Since that time, European countries have also needed IMF programs, particularly those whose banking systems had large exposures to US subprime mortgage securities during the great financial crisis of 2007 and 2008. And they had big losses, which the governments then had to pick up and support. So there were big financing needs. And we also know of the IMF involvement in the Greek balance of payments crisis, which created during the basic issue was the euro area going to survive. The IMF has had a role not just in the sort of debt restructuring concepts we typically see with emerging markets countries. Now, low-income countries with balance of payments difficulties have also shown that they have special needs. Their ability to tap market financing flows is limited, and often the corrective policies they need to take to address a balance of payments problem requires a little bit more time and perhaps more concessional financing terms. So to address these special situations, the IMF has a number of donated trust funds that it uses to provide financing to these countries on a more concessional basis and for slightly longer maturities. So that's the IMF surveillance function, the IMF financing function. And now let's talk about the next important function of the IMF, and that is as a trusted advisor on exchange rate, fiscal, and monetary policy, and related financial system and supervision issues now, providing technical assistance to members as they progress in their economic development. The IMF's role in providing this technical assistance is really unique, and no other sort of academic advisor or professional consultant can quite do what the IMF does, because it can spread the positive and negative lessons learned, not just from historical or academic learning, but from the current and lived experiences of the wider membership. Now, the IMF's role in technical assistance has changed and increased too. In 1990, the Financial Stability Forum was created, and it was established after the Asian financial crisis and the failure of a large US hedge fund, LTCM, major crises that brought to light starkly the inadequacies in financial institution supervision and regulation. In the case of the Asian financial crisis, it was the lack of adequate financial supervision in emerging markets, whether it was Thailand or Indonesia or Malaysia. In the case of LTCM, it was a failure in the US supervisory system. So the forum was established to address the need to strengthen coordination for enhanced supervision of financial institutions and the system as a whole. Its aim was to establish agreed minimum standards for rules and procedures in this area and to make those as global as possible. As I said, this wasn't a problem in just one particular country or one particular region. As part of those reforms, there was need to have a greater oversight of national progress in improving their systems of regulation and supervision. So given the role of the IMF in providing policy advice and in surveillance, it seemed like a likely institution to be able to take on this additional task. And it was asked to perform that review function, as was the World Bank that had been giving policy advice to developing countries on their financial systems. And the World Bank would focus more on the developing world and the IMF on the more advanced countries. Now, while this started out as an advisory function in the IMF, it later became a mandatory part of IMF Article 4 surveillance. Now, the fourth very important function of the IMF is its function as a forum for bringing together senior financial officials from all member countries to develop solutions to globally shared risks, often through mutually reinforcing policies. And we saw that role starkly in play in addressing the great financial crisis in 2007 and 2008, in the euro area crisis soon thereafter, and then in dealing with the economic consequences of the COVID pandemic. Now, those are the functions. But how did this stuff actually get done, right? How does the cooperation actually take place within the organization? Well, you've got a number of bodies, and at the very top, you've got the Board of Governors of the IMF. And these are finance ministers, typically, of each member country. There's one for each of the IMF's 191 members. Then you've got the Executive Board, and this is in continuous session, overseeing the day-to-day work of the fund. The Executive Board's comprised of 25 executive directors, 7 of whom represent a single country, and the rest are elected to represent constituencies or groups of institutions that elect them, groups of countries that elect them. Now, what's unique and important about IMF decision-making, whether it's at the level of governors or the executive directors, is that it's based on a system of weighted voting. So the number of votes each member gets is linked to the size of their quota contributions to the IMF. And those quotas are determined by the country's relative size in the world economy and certain other relevant factors. The other important thing to note is that most decisions by members are taken by simple majority vote. So there's no need for unanimity or even a high majority to take most actions. And this has huge practical importance to make the fund a really functioning institution. Only the most major of policy actions, such as changes in quotas, amendment of the charter, or a change in the exchange rate regime of the IMF, a movement back to fixed rates, for example, requires special majorities. And then it may either be a 70% or 85% weighted majority, depending on the issue. Now, another aspect of the fund as a substantive and functioning organization is that its day-to-day management is run by a managing director chosen by the membership who serves for a fixed term, and that director is supported by a few deputy managing directors and by professional expert staff. For much of the life of the IMF, the governors, that sort of top level governing body, typically only came together once a year at the annual meetings, and then really for pro forma proceedings and speeches and kind of pre-established votes. There were no surprises at these annual meetings. The decision was taken in 1999, however, to establish a permanent forum where governors, that is finance ministers, could meet more directly to discuss policy issues and economic developments of mutual concern and provide high-level policy guidance to the Executive Board and IMF management. This forum is called the International Monetary and Financial Committee, and it meets at the time of the fall annual meetings, but also meets in the spring, usually around April. The committee has the same composition of the IMF executive board so that it's small enough to function, but it's meeting at the policy level of the finance ministers. Now, how do these bodies actually operate? How does the business get done? Well, the regular business of the IMF, such as a review of the IMF surveillance reports or IMF loans, are prepared by the staff for consideration of the IMF Executive Board. Essentially, the bigger policy issues for adoption and discussion often originate with IMF management proposals, but those in fact may have been suggested or flagged to IMF management by a member or a group of members, like the G7, for example. And then the staff and management develop the proposals and put them to the board. So they're discussed at the executive board. Sometimes action can be taken, but often they're referred for consideration to the IMFC with some executive board recommendations. And then the IMFC considers them and may send the matters back to the executive board and management for particular actions. At times, an issue may originate in the IMFC. And generally that is because there have been some recommendations in turn by another cooperative policy body, the Group of 20, the G20. So what's the G20? The G20 was created also after the Asian financial crisis. As you can tell, people thought there was a lot wrong and a lot that wasn't working well that need fixing after that terrible experience. The G20 was created in order to get wider participation and engagement of finance ministers representing the economically significant countries. So each would have a greater voice in setting the economic policy agenda and, frankly, greater ownership of it. Now, the G20 has since involved meetings not only of finance ministers, but also annually of heads of state. And actually, it's become quite an industrial scale exercise. It's a bit out of control. And I'm sure you all are aware of the considerable debate about its continuing value and its continuing effectiveness, especially in our world of fractured geopolitics. Now, before I talk about why the IMF matters today, I do want to mention my podcast again, Brettonomics, because what you'll find there is a lot more developed discussions with policymakers with hands-on experience to talk about each of the functions I mentioned for the IMF, the roles they've played, how it's evolved. But we also talk about a number of the other institutions that were created for cooperation in international financial and monetary relations. These global financial regulatory bodies, such as the Basel Committee on Banking Supervision, the Financial Stability Board, which is the successor to the Financial Stability Forum, and the Bank for International Settlements, which is the central banker's central bank. The series also talks about institutions for economic cooperation outside the monetary and financial area, namely the World Trade Organization for World Trade Cooperation, and other international economic cooperative institutions like the OECD. We also talk about the G7 and G20, their origins and their roles. And the point of it all is to give you a sense that there's a big ecosystem of international economic and financial cooperation. And it's good to see where the IMF fits in. Okay, so now we get to the heart of today's question and the title of this conversation today. And why does the IMF matter today? What's its role? Well, without a doubt, we're at a critical juncture in global economic and financial relations. And I'm sure many of you heard a few of the speeches at Davos, which emphasized those issues, including those of Mark Carney, the Prime Minister of Canada. The US, which had been a leader and advocate of the current framework for international trade and finance, clearly is now questioning that framework's success and its legitimacy. The Trump administration seems to be complaining about three big things. First, the failure of its allies to assume greater financial and operational responsibility for our combined defense. So that becomes less of an economic burden on the United States. Second, the failure to address unsustainable macroeconomic imbalances and the policies underlying those economic distortions, particularly in countries with outsized and persistent balance of payments surpluses. And third, the inequities of the current world trading system that is stated to be based on free market principles, but which does not, in fact, operate fully under them. So the administration has been using access to U.S. markets for foreign goods and services as a sort of cudgel for addressing these grievances and creating what the U.S. believes is a more level playing field in all three areas. Now we have other countries responding to these measures and assaults with their own efforts to reduce their risks and maximize their own economic outcomes. Some believe collective and cooperative arrangements will likely be the better path. Others who have effective countermeasures are more likely to act more independently. Well, meanwhile, to the extent there's some agreement on where the current order is coming up short, in a very different world economy than existed in 1944 at Bretton Woods, what institutions are likely to be the most relevant in addressing those shared concerns? Well, we've seen some evidence of where that might be taking place. The problem of macroeconomic imbalances and exchange rate manipulation to gain unfair competitive advantage, as I said, has long been in the IMF wheelhouse. It's a fundamental issue in bilateral and multilateral surveillance. The G7 clearly stated that doing this more effectively needs to be on the IMF's agenda. And President Macron, who chairs the G7 this year, has cited macroeconomic imbalances as a key issue to be addressed in those discussions. The IMF also has a major review of its surveillance policies this year, so watch that space for some changes. And the United States is chairing the G20 this year, so we can expect macroeconomic imbalances to be on that agenda too. Now, related to these imbalances, as well as the distortions of the global trading system that the U.S. has been complaining about, is the issue of what to do about a world economy that is not wholly based on free market principles. We know there's one large and dominant trading partner that operates a heavily state-guided economy with growth based on structural balance of payments surpluses. We saw the G7 finance ministers communique in May of 2025, highlighting that significant work needed to be done on how non-market policies and practices aggravate imbalances, contribute to production overcapacity, and impact the economic security of other countries. Now, while this is a concept particularly in respect of China, other countries are also increasingly intervening in their own markets to address supply chain resilience, national economic and political security, and growth of sectors deemed strategic, like AI. So this is the world we live in. And the question is, how do we want to assess what actions are overtly damaging to the international financial and economic system and not, in fact, acceptable behavior? This question, in my mind, is one that goes to the very heart of IMF Article 4 surveillance. Meanwhile, the U.S. approach to this distortion is to impose tariffs as a financial countermeasure to what it sees as manipulative domestic policies for unfair competitive advantage. We're also beginning to see a growing acceptance of the need for reforms in the world trading rules and the operation of the WTO. It's an institution that in its charter states that it is fostering a market-based trading system. But its rules are in fact riddled with pragmatic and politically driven exceptions for non-market-based behaviors. And there's a lack of effective redress when countries either are non-transparent about their policies or flatly don't meet their commitments to act on a commercial basis in international trade. The rules and operations, I think, are generally viewed as in need of modernization, but that's going to be a lengthy process. Meanwhile, what we're seeing is countries continue to see value in maximizing open trade on market principles, and they're negotiating new bilateral, plurilateral, and free trade agreements, notwithstanding the chaotic current environment. So yes, we do have a rupture in global economic relations and a scrambling by all countries to try to minimize risk to themselves and maximize benefits. And as I noted, we can see some institutions where we expect to have some constructive dialogue, at least for that dialogue to begin. Now, to keep all of this in perspective, let me go back to another period of severe rupture in the system of international rules and international monetary cooperation. And that was the collapse of the IMF's par value system. That began in 1971. The system began to show it was just not sustainable any longer. And the United States determined that having its currency at the heart of the system and tied to gold was not an economic policy straitjacket it could afford to wear any longer. It cut the dollars linked to gold, and then the international community had to negotiate what the new rules of the road would be in a world of more flexible exchange rates. That was not a quick negotiation. The negotiations were not concluded with an agreement until 1976, and then it took another 2 years for those proposed amended articles to be adopted in 1978. And then after that, the IMF members needed to feel their way in making the new system work. But during that time, the world economy did not crater. It did not collapse. It kept chugging along, sometimes in fits and starts. And the IMF continued to have an important role helping its members through the transition. So today, while the tensions in the future of the system are being played out, the IMF still matters. Its surveillance and economic analytical role is critical as the economic and financial impact of these seismic changes are felt across the membership. If you think only about Europe, for example, it's not just dealing with the trade pressures and US pressure to reduce trade barriers and subsidies. It's also having pressure on its level of defense spending. Plus, there are the recommendations of the Draghi report on what is really needed in the area to strengthen overall European economic and financial integration. Well, how do you accommodate for all that change in an orderly way? It's going to make the IMF sharpen up its surveillance toolkit for sure. In addition, the current period of economic and geopolitical tensions will inevitably create stresses where the IMF's financing will be important. And the IMF will have a large role in advising lower income countries on how best to adapt to an environment in which they have very little control. And finally, the IMF in the end, I predict, will have a major convening role and trying to get members to resolve their differences over how the system needs to be improved and to be fairer and more open and fit for the modern era. Now, of course, at the same time as we're going through all of this international political and economic tension and upheaval, all the other economic and financial forces, as well as natural disasters that buffet an individual country and the system more broadly, are still in operation. We have, for example, remaining distortions and debt overhangs from the era of the COVID economy. We still have persistent inflation. We have relatively high leverage and lack of transparency and unregulated parts of the international financial market. And we have the impact of rapid technological change in all sectors and aspects of life, whether due to AI or the explosion of digital finance or other technological change. So why do we need the IMF? I think it's obvious. It's uniquely capable in terms of expert resources and analyses. It's pre-positioned in terms of financial resources. It has a convening power to help its members identify those risks and reduce them where possible, and address crises as they arise. There's no other body or forum that can play this pivotal role in protecting the international financial system and global growth. So that's my story, and I'm happy to take questions from any of you.
Thank you very much, Nancy, for providing the audience, the students, and the experts, which in the end were 30 people, so more than I had anticipated, given that we only announced it for a few days. And it was quite a tour de force and an excellent summary, both on the birth of the Bretton Woods Institutions, the functions of the IMF, and the ongoing relevance, and the fact that for all its shortcomings, the IMF has no substitute, and it will be, given that what you have said about crisis, and it really took a major crisis, World War II, as well as the interwar period of economic depression, recession, hyperinflation, and the general economic crisis, and a World War II to come to an agreement of give up sovereignty in an area which has actually proven to help those countries that have been in balance of payments problems through the years, but also to have, as sometimes have been called, and in one of your Brettonomics, you refer to it like a global policeman that looks at the surveillance of economic affairs. And no other institution has this, even in the age of AI, this unique information and data about the countries. So this was really, really very, very useful. And again, I commend you not just for your experience and knowledge, but for having in the digital age, of having taken the initiative of sharing this knowledge in a format which is appealing to the younger generations, which is the format of podcast. And many in that young generation or in attendance today, and I always feel that I need to pass the torch to the next generation while I still have the energy to teach at Queen Mary. So we have here some questions. Daniel will have the first question, and then others obviously can either raise their hand or just contact me via the chat feature and ask any question that they may wish to pose to you, Nancy. So Daniel.
Okay. Yes, thank you very much, and thanks for your excellent presentation. My question is quite actual today, and in fact, I mean, you don't need to answer 100% if you don't feel comfortable. It's more it's more about what happened, I mean, in the Maduro case. And so how would, my question is, how would the IMF assistance affect Venezuela's economy post-Maduro? So what role the IMF would play in resources and programs that they could affect debt sustainability frameworks, stabilization advice, if it is something that you can discuss, or if you can share your view on this point.
Yeah. Well, I think, the IMF has been uniquely successful with a range of countries that have started out in very varying circumstances, whether it was after the collapse of the Soviet Union, in helping countries move from what were state-controlled to more market-based economies. And a lot of that learning, it seems, will be relevant to helping Venezuela over time move to a more successful economic model if it's politically willing to do so. It's also worked with failed states in trying to get some of the basics into place in terms of functioning institutions and making sure that all of that works. And, you know, I worked for Citibank for 7 years. And for part of that time, I was the counsel for the emerging markets countries. And I found that fascinating because, you know, it was giving legal advice was as much about giving political science advice, because the law courts weren't necessarily fully functioning. Bankruptcy systems weren't necessarily fully functioning. Graft and corruption was often part of the scene you had to deal with. And so having that knowledge of working with many, many countries that had institutions that were in need of strengthening is also something that the IMF is good at, and so is the World Bank, for that matter, in terms of institutions. So, you know, I think it's early days. You can't run in and pour money into a non-functioning system, or one that isn't quite sure where it wants to go, except to improve their prosperity. But when the time is right, IMF technical advice and IMF financing is certainly going to be part of the mix. But there, you know, there's a world of varied experiences, and the strength of the IMF is it can kind of take and learn from all of those and get them to fit the specific situation of the country they're helping out.
Thank you very much, Nancy. Jose Enrique, you have a question if you want to ask the question yourself.
Yes, thank you. Thank you, Ms. Nancy, for such an interesting presentation. My question is regarding the large and complex structure of the lending facilities of the IMF. And I wanted to know, from your perspective, do you consider that these menu of options can be maybe simplified, or, simplified even more, considering that in the past, the IMF has already eliminated some of its lending facilities?
Yeah, I mean, I think that there's an alphabet I can't even keep up with in terms of some of the special facilities. And I think there's been, I think one of the initial suggestions of the U.S. Treasury Secretary Scott Bessent, when he made his first address after taking office to the IMF, was that there's a need to get back to basics. And I think getting back to basics is also trying to understand what are the core facilities, what are the strengths of the IMF, is it beginning to provide financing in areas where it lacks the expertise? Is it then causing its own resources to be spread too thin because it's got a, you know, there's a cap on it, what kind of a administrative or bureaucratic body you can create, how many people you can hire, and if you spend more of them doing things that are tangential to the core functions, it's going to detract from doing the core functions well. So yeah, I mean, I think all of that will be sort of part of what we'll see going forward. But you know, there are a few facilities. I'm responsible for creating one when I was there. There was a report by something called the Independent Evaluation Office of the IMF, and it had done a report on prolonged use of fund resources, which is another issue today, all these sequential programs. Does a country ever get out of a program? Well, what the IEO team had looked at was all of the developing countries, particularly the low-income countries, that were in these perpetual IMF programs. And it wasn't so much driven by what the IMF thought was needed or the country thought was needed, but a lot of the aid donors did not have their own macroeconomic staffs to analyze the debtor countries. And so they were essentially using the IMF as their adjunct. And without an IMF program, they wouldn't give their aid. Well, I thought this is utterly insane, right? Why are we forcing the country to take our money where we do have some interest rate. It's not totally concessional. Go through all of this, and how are we building up the capacity of the country to develop their own economic programs and their own economic policies and have real ownership of what they're doing? So I said, I want a program that's not funded. I want one that gives a signal that if you want me to say how I think the country's, here's their economic policies, this is kind of what we think about them. These quarterly, I'll look at what the impact of the policies are. How's the sustainability of what do their deficits look like? How's their currency doing? I'll tell you that. I'll give you the economic analysis. But you, the aid donors, give them the money and give it to them as grants and give it to them as concessional as you can. So we came up with that. And what I found in trying to build consensus is at the time, the US was chairing the G7. And I was having trouble with my G7 peers whose aid organizations wanted the old system. So I said, well, I'm going to go talk to the borrowing countries. And at the time, the finance minister of Nigeria, who was now the head of the WTO, saw this proposal and she said, finally. And so I was getting all of the executive directors representing Africa, right, supporting this thing and thinking it was a good idea. And so it isn't that it's been used a lot, but when it's used because the country really wants a different instrument. So some of these things, don't have wide use and are useful, but others, as I said, are kind of taking the IMF away from their core function rather than kind of what I was trying to do, which is keep it a little bit more pure in terms of what an IMF program is. So anyway, that's a long answer with a little bit of personal history.
That's really interesting, and thank you, Jose Enrique, and thank you, Nancy, for that question, which in a way shows that the evolution of IMF facilities has actually been far more flexible than sometimes people that do a critique of IMF programs of either regular lending or concessional lending over the years take into account. So that was a very, very good answer, and also drawing on your own experience. We have here 2 questions in the Q&A, and I'm going to read them to you. Pier Paolo Albo ask you, Nancy, given today's geopolitical shifts, how might IMF members' quotas and voting power evolve? And can quota reform remain effective in ensuring legitimacy and representation? Well, I'll ask this first and then the other one.
Okay. On that one, I have going to give you a very candid view. Your quota, right, delivers you, if it increases, delivers more votes because your weight, right, in the system goes up. My personal view is you should get more votes, which is a benefit if you're meeting all of your responsibilities. So I think before we talk about quotas and voting weights, we need to have a real frank discussion on what members' obligations really are under Article 4 in this modern age, right? Mm-hmm. What kinds of persistent structural imbalances, whether they're China's or a surplus in Europe or a deficit in the US, to what extent are we meeting our fund obligations? And to what extent do we deserve the votes? I mean, one consequence of not meeting your obligations today, there is a provision that was put in connection with issues of potential debt default by members and what the consequences might be. But there is a provision that says if you're not meeting your obligations, you don't get to vote. So I think we got more fundamental issues on what our expectations are of these institutions before we decide what's fair or unfair in terms of a voting lineup. And I don't think legitimacy depends on changing quota shares. I think legitimacy depends on the institution actually serving its purpose.
That's a very good answer, Nancy, reminding that membership in an international organization, any international organization, but certainly the IMF, gives you rights and responsibilities, obligations, and the obligations of the IMF were very well defined in Article 4 and Article 8. So as a lawyer and in a legal policy session as this is today, which obviously has huge economic impact, is going back to basics to remind that members have important obligations as part of being the obligations of membership of the institution. The last question is a fitting one. It comes from Omer Farouk Engel and asks, what would be the role of a lawyer or a young lawyer working at the IMF in all these current issues, which is a nice fitting final question that bridges the experience that you and I enjoyed at the IMF with the future experience that some of my students now and other perhaps attendees in the seminar may enjoy in future. So that would be your final question today, Nancy.
Well, I think I think Rosa, in a sense, you are more competent to answer this one than I am because you've worked in the IMF legal department. I haven't. I just sat at the executive board making demands or contradicting some of the legal advice that came out of the staff. But the lawyers are really essential, and my view is that I've been a lawyer for a good part, certainly more than half of my career, are really essential to make the institution function. So whenever there's a proposal for a policy change, you need to make sure that it's consistent with the IMF articles. When there's a need for novel conditions in an IMF program, you need to be looking at that. When you're looking at, fundamentally, are we going to change some of the rules of the game? That's, can we do it under the existing articles? How do you interpret them? Are we going to need amendments? If we need amendments, what's going to be required to get that through? Remember, 1976, it took us 2 years to get all the votes through and get changes ratified. I think there are some fundamental issues, and more I think about what the issues are in the system today, and I kind of previewed this in my remarks, is there's a real issue of where trade rules end and IMF macroeconomic issues begin. In other words, if what you're doing is creating these huge macro imbalances, that represents trade surpluses, right? And so this is very much a part of or integral to what we want the international trading system to look like and what the rules should be. So I think there's going to be a lot of, if we're doing it right, consideration of the integration of the issues that are now considered in the WTO and those in the IMF. And the GATT rules and the WTO rules permit you to impose tariffs on a temporary basis for balance of payments purposes. If the Trump administration had done it legally, they could have slapped on 10 or 15% tariffs across the board on everybody temporarily and saying, we got a balance of payments problem. And they did that in 1971 with the oil surcharge. And that was viewed by the fund as a permitted duty for balance of payments purposes, and it's told the WTO that. So there is this relationship, and I think those are some of the most interesting and difficult legal issues, and I'm hoping the world gets to the point of looking at them, because I really think it's sort of at the heart of what's wrong with the system today.
Thank you, Nancy. That was really a very fitting finale. and a reminder that the law and lawyers have a very important role in international economic organizations such as the IMF, the World Bank, WTO, and that sometimes the mandates and the cross mandates and the intersection of the mandates between the organizations, those were drawn a time ago, and sometimes they need to be revisited in the light of the current circumstances, and also in the light of the current geopolitical circumstances, which is what this talk was about. When the IMF was created, the US was a major creditor country, and the UK, under the proposals of Keynes, John Maynard Keynes, was the debtor country. These days, things have changed, and so it is interesting, the balance of powers. It's good to remind ourselves of the mandate and how to reconcile the mandate with the changing geopolitical and economic circumstances. So that was really a nice way of closing up today's session, Nancy. And in a customary way, we're not in a physical room where we will all be clapping to you, but allow me to do a virtual clap and every of the participants to join me in clapping and expressing our gratitude to you for the session today. Thank you very much.
Thanks for giving me the opportunity, Rosa. I enjoyed it.
Thank you. Bye-bye.